Hi, good morning everyone. My name is Anuj Jindal and today we are going to discuss some questions on finance for RBI Grade B examination 2018. These questions are advanced level questions and not the very basic level of questions that you will find on other websites. The purpose of these questions is to build upon two things: your conceptual clarity on various aspects of finance and also pertaining to various issues in current affairs on finance. I will build up on all of them one by one. So we will be taking some questions related to concepts and also at the same time some questions related to current affairs for finance. In my revision batch, which is going to be launched soon, we will be taking up a lot of questions and a lot of concepts related to current affairs for finance as well as ESI for RBI and NABARD examination. So without wasting any time, let's start with the discussion where I'm going to take about 9 to 10 questions on finance related to concepts as well as current affairs. The first question is, when an already listed company issues fresh securities to the public, it is called as what? So if you're clear about the difference between initial public offer, follow-on public offer, rights offering, bonus, IPO, all these things, then you will find it easy to get through this kind of a question. And these kind of questions have been asked in phase 1 last year and also in phase 2 finance section. The question is, when an already listed company issues fresh securities to the public. So it's an already listed company and it is issuing fresh securities to the public. It is called as follow-on public offer. So whatever securities have already been issued by the company, or if the company is already listed on the stock exchange, whatever issues are made by the company, they are going to be called as follow-on public offer. The terms which are connected to this kind of offering are: number one, rights offering, then bonus offer, and then initial public offer. When a company which is unlisted gets listed for the first time and issues securities for the first time, then it is called as an IPO. Rights offering is the offering which is made to the existing shareholders first. For example, there are 10 shareholders in the company holding, let's say, 1000 shares each, and the company wants to come out with another set of 5000 shares. Then these shares are going to be first issued to these 10 shareholders in the proportion of their existing shareholding. So everybody holds 10,000 shares each, so everybody's holding is equal, and therefore these 5000 are going to be divided equally. Therefore 5500 shares are going to be issued or are going to be offered to all these 10 shareholders individually. And when they when they accept the offer or do not accept the offer, then these shares can be issued to other people, either the public or privately. Follow-on public offer, we have already explained. Bonus offer is when you provide bonus shares to the already existing shareholders. For example, these 10 shareholders hold 1000 shares each, and the company decides to come out with a bonus issue of 5000 shares, wherein all these 10 shareholders are going to get 500 shares each extra. So the shareholding of every shareholder is going to increase automatically to 1500 shares without them having to pay anything. There are various reasons of issuing or coming out with a bonus offer. When the company wants to reduce the per unit price, when the company wants to instead of paying dividends wants to issue extra shares, when the company has a lot of cash and it wants to use it. So various reasons are there behind issuing or coming out with a bonus offer. The next question is, which of the following is SEBI's eligibility norm for issue of rights issue by a listed company? The question, again I repeat, SEBI's eligibility norm for rights issue by a listed company. So if there is any company which is listed with SEBI, which is already trading on the stock exchange, and it wants to come out with a rights issue, what does SEBI have to say about that? The company should have paid up capital of at least rupees 2 crore. The company should be listed for 5 years at least. The company should not have made losses, or none of the above. Now it's very important. In this question, you will get it wrong if you don't, number one, have any information or knowledge about rights issue, or number two, if you do not use your common sense. So rights issue is a mandatory stipulation made by SEBI for certain classes of companies. So if a company has already issued a certain number of shares and it has certain shareholders and it decides to come out with further issue, then it's mandatory for the company to first offer the new shares to the existing shareholders, and that is what is called as rights issue. So technically there are no eligibility norms. Every company which is already issued shares, already listed on the stock exchange, already coming under SEBI, registered with SEBI, has to go for rights issue if it wants to issue extra shares. Therefore, there are no eligibility norms, because if these eligibility norms are created, then the companies might want to get away from rights issue in order to expand itself, in order to have as many shareholders as possible and not have a limited number of shareholders holding a lot of shares. Therefore, the answer is D, none of the above. So, if you understand the idea or the purpose behind rights issue, you might get it right, even if you have not read this kind of any stipulation or eligibility norms by SEBI. So, although this question looks more technical, but you can take a guess, a calculated guess, by by applying your mind about the purpose, the ultimate purpose of a rights issue. The next question is, what is full form of UPIS? Now, UPIS is Unified Package Insurance Scheme, which was launched in the year 2016. The purpose of UPIS is very similar to what we have called Pradhan Mantri Fasal Bima Yojana. So we have PMFBY. Unified Package Insurance Scheme includes Pradhan Mantri Fasal Bima Yojana. It provides agriculture insurance. It provides life insurance to farmers, and it also provides insurance on pump sets. So these are the four parts of Unified Package Insurance Scheme, which was launched on a pilot basis in the year 2016, and after that it has been expanded. So Fasal Bima Yojana, about which you are very much aware, and it has been in news consistently, everybody knows about that. But a question can be framed on Unified Package Insurance Scheme because Fasal Bima Yojana forms a part of Unified Package Insurance Scheme. The next is, under Pradhan Mantri Fasal Bima Yojana, premium to be paid by farmers will be only 5% for what all things? Now, a lot of students are aware only about three things: Rabi crops, Kharif crops, and horticulture crops. And you are aware that on Kharif it is 2%, on Rabi it is 1.5, I believe, and on horticulture it is 5%. But you tend to miss out the information or the fact that annual commercial crops are also used with horticulture crops. So commercial crops which are not a part of horticulture crops also come under the 5% category. So the answer is B and C, and not only C. So a lot of students might be influenced by it, be incentivized to go with the answer C, but the answer is actually E, that is commercial crops as well as horticultural crops. Which of the following risks are not covered under Pradhan Mantri Fasal Bima Yojana? It includes flood, inundation and landslide, droughts and dry spells, pests, diseases, etc. It does not include theft. So any kind of natural disaster or loss created or suffered because of natural disaster by the farmer is included or is a part of Fasal Bima Yojana. Whereas theft is not a natural disaster. And through that understanding also you can answer the question, because first three are actually natural disasters, but the fourth one is a man-made disaster. The next question is, the price discovery of a public issue is possible through what all things? Price discovery. In initial public offer, follow-on public offer, you are not actually discovering the price. You are offering a price at which the investor can invest in your shares, and the investor decides whether to do it or not to do it. In a prospectus issue, you create a prospectus, issue a prospectus, which includes the price as well. And the person who wants to invest decides whether that price is right or not. On the other hand, in a book building method, if you have not read about it, you might feel that you're not capable of answering this question. But you need to have gone through the book building method in order to be able to answer this question. Book building method is a method wherein the company first creates a range, let's say 10 rupees to 25 rupees. So this is the range that it has created. It is an example, hypothetical example that I've created. So 10 rupees to 25 rupees range has been created. Now the public, the people will come forward and offer how much they are willing to pay for this share. Let's say Tata comes out with a book building issue and it says that the range is 10 to 25. The people say, or the institutional investors say, okay, Tata Power is going to grow very fast in the future because of increasing electricity demand in urban as well as rural areas, and therefore rupees 20 is the right price for this. Rupees 10 would be too less because at that point I will not be able to get a subscription to these shares. So it's kind of an auction which is happening, but in this auction the price is going to be decided later. So what happens is institutional investors, people say that 20 is the right price. Somebody says 21 is the right price. Somebody says 15 is the right price. Let's say 1000 people say 20 is the right price. 500 people say 21 is the right price, and 200 people say 15 is the right price. So because majority of the people are saying that 20 is the right price, so the company is going to finalize this price as the issue price and then come out with the actual issue at rupees 20. So this is called as book building method, wherein price discovery based on demand of that share in the market is found out. The next question is the book running lead manager in a public issue means. So the book running lead manager is the manager who manages the issue of shares for a company, and he's also called as merchant banker because he's the one who's trying to create demand for this public issue. He's the one who's carrying out all the rules, who's carrying out all the formalities, complying with all the rules and regulations by SEBI, and making it a reality. At the same time, the merchant bankers can also act as underwriters and can buy or can act as anchor managers, anchor investors, wherein what they do is, let's say this is a company and it wants to come out with the issue of 1000 shares at the rate of rupees 100 each. So 1 lakh rupees it wants to raise. It hires a merchant banker. The merchant banker does all the work and makes sure that it goes to the public. But the public is not very willing, or the company does not want to take the risk of sending it to the public and then facing an issue wherein only, let's say, 20 people or let's say 200 people subscribe to the shares, because then it will have raised only 20,000 rupees. So what it does is it asks the merchant banker, will you act as anchor manager for me? The merchant banker says, okay, I will do it. I will buy all 1000 shares at rupees 90 from you. So the company gets 90,000 immediately, but the anchor manager can go to the market and sell these shares at rupees 100 or at any price that they want to sell it at, and therefore there are chances that the anchor manager will make a profit of rupees 10,000. There are also chances that the anchor manager might incur losses if the people are not interested in buying those shares, and that is the risk that they undertake in order to make some money. So the merchant bankers are the managers or the bankers who carry out the book running process, who make public issue a reality, and who also act as anchor managers for the company. The next question is, are NBFCs monitored by RBI? If yes, how? Yes, they are monitored by RBI. Yes, using comprehensive inspection manual brought out by the RBI. A very generic point, therefore must be true. With the assistance of external chartered accountants or CAs, auditing is a necessary part, and therefore yes, it must be true. On the basis of Camel's approach. Camel's approach I have already discussed in another video under Indian financial system, so I'm not going to discuss it yet again. Yes, it is used for both monitoring of banks as well as NBFCs. So the answer is all of the above. In case of foreign banks, a very important point, another system called Calcius system is used by RBI in order to monitor and find out how these banks are performing. So Camel system is for domestic banks and NBFCs. Calcius system is for foreign banks. The next question is, what is the amount of paid up capital and reserves to qualify for being classified as a scheduled bank as per original guidelines? A very factual question. You are expected to know the answer, rupees 5 lakh. Some people might think that the answer is 2 lakh. 2 lakh was the original amount of paid up capital that was required, but now the amount has increased to rupees 5 lakh. So that's all for questions on day 3 on finance for RBI as well as NABARD Grade B examination. Tomorrow I'll be coming out with certain more questions related to finance as well as ESI, which are going to be very important for RBI Grade B examination 2018. If you like these questions, please subscribe to my channel so that you can have more of these questions every day in your notification, and I get more motivated to make more such videos which can help a lot of students who are self-studying to prepare better for the examination.